Almost 20% housing price drops are seen in Toronto in just over 6 months. Multiple price decline records are being set, inflation is soaring, interest rates are going up, and the economy is starting to suffer. I have dug out the most recent data for you and I will explain the key Canadian housing dynamics. And at the end of the video, I'll give you the facts which tell us, is the Canadian housing market going to pop or not? There are enormous opportunities for the ones who can predict the future, and in finance, the stats tell us all. As always, everything said is with educational purposes and should not be considered to be financial advice. So let's start with our analysis. Over the last decades, the Canadian housing market has become synonymous with its real estate bubble. According to recent data from UBS, Toronto currently is considered to have the most overvalued stock market in the world, as seen in the provided graph. In second place comes Frankfurt in Germany, then Zurich in Switzerland, and Munich and again Germany, with Vancouver, yet another Canadian city, taking spot number 6 as the world's most bubbliest housing market. This incredible drive in unaffordability has been driven mainly by record low interest rates deployed through the pandemic, alongside demand for larger living spaces that lockdowns provoked, drove housing markets around the world into a buying frenzy for much over the past 2 years. That's now starting to reverse as rates rise. What is very surprising is the sudden drop in prices in Toronto. Since February of 2022, prices have declined by 19%. Compared to February 2022's average sold price was about 1.3 million, the average home sold price in the GTA has fallen by 248,000 in the past 7 months. The benchmark price for the GTA was 1.1 million for September of 2022, down 1% month over month from 1.12 million in August of 2022. Prior to April of this year, the benchmark price had risen for 19 consecutive months starting from August of 2020, until the peak in the GTA's benchmark home price reached in March of 2022. According to data coming from Bloomberg, the drop in prices is 17%, not 19%, and we can see this on the provided chart. From about a peak of 1.32 million Canadian dollars reached in February to about 1.1 million today. Meanwhile, in Vancouver, Canada's most expensive real estate market, benchmark prices fell by 2.1% in September, bringing the cumulative decline in the last 6 months to about 8.5%. Recent data from the end of September, stemming from the Terranet National Bank House Price Index, sees a record monthly decline in prices for August. What is most amazing is that the drop month over month is just 2.4%, and yet this is enough to be considered a record. This index looks at the 11 biggest cities and takes the average price movement. During August, 9 of the 11 biggest cities experienced price contractions. Calgary and Edmonton were the exceptions, with a 1.3% increase for Calgary and a 2.8% increase for Edmonton. The steepest price declines were seen in Hamilton with a minus 5.4%, Ottawa with a minus 3.8%, and Halifax with a minus 3.6%. On the next chart, we see the average Canadian household income for 2022. The average annual income is $75,000. This comes out as around $6.2K per month or $36.28 per hour. The annual income is important because it gives us a good starting point from which we can analyze whether a housing market is over or undervalued. According to the so-called home price to income ratio, an optional and balanced level is no more than 2.5 times. So if the annual income is $75K, then the average home price should ideally not exceed $225K. Well, according to the National Bank of Canada, the average price for a house in Toronto metropolitan area is about $1.4 million. This comes out to a home price to income ratio of 18.66 when we divide the two. A condo, on the other hand, comes with an average price of $764,000, which is also a 10.18 ratio, 4 times higher than what is considered to be a good level. The most expensive house market in Canada is the Vancouver market. The scenario there is also quite overvalued. After a decades-long rise in home values, it is normal to have a decline. The question is, are we going to see a continued drop in prices? In order to answer this question, we must look at the main causes for the current drop in prices. A major reason is the increase in the main interest rate. As we see on the chart, we went from a record low of 0.25 to about 3.25%. And this has happened from March of 2022 until September of this year. This has been one of the fastest interest rate hikes in Canadian history. This causes all credit and loans to become more expensive, as the credit system is what expands an economy the most. By making credit more expensive, this makes people spend less and save more, which slows the economy down. Here comes the important question: why does the government want to stop the economy from expanding? Well, because it wants to stop the inflation from going higher. For now, it looks like Canada has reached its peak inflation of 8.1%, reached in June of this summer, and the current level stands at about 7%. But 7% is still not good enough. The goal of every central bank is to bring down inflation levels to between 2 to 3%. Anything above that is high inflation, and it erodes the financial system of the country. The economic laws and the economic history tells us that if the central bank wants to bring down the inflation level sufficiently, it needs to bring the interest rate back above the inflation rate. This would mean that from 3.25%, the rate needs to go to about 7.25%. But this is not possible, as the government and corporate debt repayments are way too high for the Canadian economy to handle. What the central bank most likely will try to do is it will try to bring down the inflation rate with not so high interest rate rises. This has of course never happened before in history, but there is a chance it may work out this time. One indicator which shows whether the government has more room to increase rates is the unemployment level. The current level of about 5.4% is one of the lowest in recent decades, and it shows the Canadian labor market is still holding strong. The economic expansion stops when the unemployment rate starts to go up higher, and with that the economic activity contracts and the inflationary pressure starts to contract as well. The low unemployment levels indicate that the Canadian Central Bank can be more aggressive in its rate hikes, at least for the moment being. As this happens, the home mortgage rates would continue to go up, as seen on the chart from Y charts. The current level of the 5-year conventional mortgage rate is about 5.58%. The low was hit in August of 2021 when the rate was 3.2%. This is an increase of 75% in just over 1 year. Overall sentiment, according to the great investors such as Ray Dalio, Stanley Druckenmiller, Paul Tudor Jones, and others alike, is that in the coming years credit will become scarce and more expensive, and this directly affects all asset classes negatively, but especially the real estate sector. It would not be a surprise to see the Toronto real estate market to see a price drops of 50+%. As of October 2022, the market consensus on the mortgage rate forecast in Canada is for the central bank to increase mortgage interest rates by another 1% in 2022 from 3.25% to a high of 4.25%. This would put even more strain on housing demand, and it would make even more people want to sell their existing home, which has a variable mortgage rate. Another fact which supports the very overvalued housing market and the possibility of a crash is the extreme price-to-rent ratio, which is seen in Canada. On the graph, you can see the top 10 countries ranked by this metric. Canada ranks the 8th most overvalued country in the world, with a level of 160, although still there are 7 more countries ahead of it. On the next chart, we see how this level has been constantly and drastically rising over the last 22 years. It is clear if we see the chart the massive increase of unaffordability after March of 2020 when the government printed insane amounts of currency. Yet another supporting fact about an upcoming disruption in the demand and supply dynamics of the Canadian market is the record high building permits. What will happen now is we are going to see a lack of demand brought by higher interest rates and a record increase of supply from newly built housing. This in economics is a recipe for an astonishing price decline. On the provided chart, you can see the incredible increase of building permits. This is by far and away the biggest building spree in Canada's history, and with so much supply, it is really hard not to see a stall or fall in the market. The overall theme which can be derived from all of this data is that the house prices have a significant room to fall. With the current and upcoming lack of demand and newly coming supply, the situation is not looking bright for homeowners. But this will make it possible for the next generation of home buyers to be able to afford to buy a home. If you're interested in this kind of content, it would be best for you to check out our other videos on the channel as we cover multiple other topics. Subscribe to the channel and hit the bell icon so that you also don't miss out on any future valuable content, and I'll see you in the next video.